Hello, everyone. Good evening, good afternoon, or good morning, depending upon where you are in the world today. Thank you for joining our discussion, Integrating Environmental, Social, and Governance Factors, presented in partnership with the Wharton School. My name is Alex Baran-Priya, and thank you so much for having us be part of this series. I'm one of our co-founders here at Ivy Exec, and I'm truly honored to have Ivy Exec host today's session. And equally so, I'm humbled to be alongside my counterparts from the Wharton School, Peggy Bishop-Lane, and our featured speaker for today, Witold Henisz, who you'll be introduced to in a moment. And just before we jump in, just give a little bit of the context for our discussion today. In less than 20 years, the ESG movement has grown from a corporate social responsibility initiative that was launched by the United Nations into a global phenomenon that represents more than $30 trillion in assets under management. And as we'll discover today, if a business case for ESG issues can be demonstrated, pools of capital are poised to make an impact. And so it's certainly a topic that we're very interested in and would love to learn a little bit more about. And we appreciate the Wharton School bringing on this subject matter to our community. Before we begin, and I hand it over to Peggy to introduce our guest speaker for today, just a few brief housekeeping issues that I wanted to make sure that our audience is aware of. First, all of our attendees are in listen-only mode, so we do want to encourage you to engage in the session by asking questions. I'll be serving the role of moderator, if you will, behind the scenes. You'll see a questions box in your control panel. Please feel free to drop your questions there. And intermittently throughout the presentation that we will have, we'll look to bring those questions to bear during the course of the presentation. Additionally, we'd love to have you weigh in on the discussion and participate in a number of interactive poll questions that we'll be launching throughout the presentation at appointed times during our 1 hour today. And then finally, just so that you're aware, we are recording our session for today, so please feel free to access the recording, which we will be sending via email in the days to come. And now it's my pleasure to pass it over to Peggy Bishop-Lane, Vice Dean of the MBA program for executives at the Wharton School. Peggy?
Thank you, Alex. And hi, everyone. Welcome to today's webinar, which is sponsored by the Wharton MBA program for executives. As Alex said, I'm Peggy Bishop-Lane. I'm the Vice Dean of the program, and I'm also an accounting professor. A little bit about our program first. The Wharton MBA program for executives is one of 3 ways that students can earn the Wharton MBA degree. Our program is suited to mid-level and executive level professionals in a variety of fields, industries, and functions, including media and finance, healthcare, government, engineering, entrepreneurship, and data analytics. The program is offered in an every other weekend format in Philadelphia and San Francisco, and beginning in May of 2023, will be available in a blended online and residential format through our new global cohort. Today, we are pleased to have Professor Witold Henisz, the Deloitte & Touche Professor of Management and Vice Dean and Faculty Director of Wharton's ESG Initiative, to share his thoughts on environmental, social, and governance factors and how to integrate them into business practices. We hope that you'll find this not only interesting and useful, but that it will also give you an idea of how faculty bring their research into the classroom. Professor Henisz's research examines the impact of political hazards, as well as environmental, social, and governance factors more broadly, on the strategy and valuation of global corporations. His most recent work focuses on the application of alternative data to the measure of non-traditional political and ESG risks and opportunities for multinational firms, as well as the performance of the asset managers that invest in them. Just last month, Professor Henisz led a group of Wharton Executive MBA students to London to study these issues. In addition, he teaches the political and social environment of the multinational firm and corporate diplomacy to all levels of Wharton students, and is the recipient of numerous teaching awards. Most relevant to today's talk, he won the Aspen Institute's Ideas Worth Teaching Award in 2020. He works with numerous consulting clients, and in particular was instrumental in helping Engine No. 1 develop their total value framework. Here today to discuss integrating environmental, social, and governance factors is Professor Witold Henisz.
Thanks, Peggy. Thanks for that introduction. Thanks, Alex, as well for this opportunity to present to the Ivy Exec audience. It's great to have the opportunity to be here and share some of the ideas. ESG is very much in the headlines, both for good and for ill. There's some pushback against the movement that Peggy described and the trillions of dollars of assets that have moved in this direction. And what I'm hoping today is to cast a little light on where we are in the progression towards ESG. How much of this is real? How much of this is greenwash? What should we be looking at going forward in terms of advancing our ability to integrate environmental, social, and governance factors into valuation decisions, into strategy, whether we're looking at asset managers, corporates, consultants, or others. Along the way, as Alex mentioned, we'll be having a number of poll results and polls that will be interesting to see your responses to. And I think they're going to drop the link for that into the chat. And please do ask questions along the way as well. So my agenda today is to give you a little bit of a quick overview into what is the ESG movement for those that are a little new to it. What do we mean when we talk about environmental, social, and governance factors? Spend a little bit more time talking about why they've become so much more important. Why is it over the last 3-5 years, depending on how we count, that this has gone from being something on the periphery, a little bit on the outside of the mainstream discussion, to really in the absolute centerpiece of the discussion around finance and investing. And then what's been going on in the last couple months where there seems to be some pushback. What's going on in Florida, Texas, on the cover of The Economist or in the Wall Street Journal that's saying, is there really a there? Does the emperor have clothes? We'll be talking about that. And then I'll try to thread the needle and talk about a way forward. And that's going to draw heavily on some of the work I did with engine number one, but really trying to address some of the concerns in a way that is constructive. Not just giving up on the ESG movement because it has flaws, but pointing a new way forward and a new way of looking at the value of ESG. Conclude with a little bit of the uncertain future of ESG investing and the role that the ESG Initiative at the Wharton School hopes to play in that. And again, taking your questions along the way and at the end. So what is ESG? ESG is a set of environmental, social, and governance factors which are thought to affect long-term financial performance of a company. We can try to assess how the company is doing in the short term on issues like climate change and the climate transition, on social justice, racial justice, and then project how that'll impact shareholders in the medium to long term. Sometimes the effects on shareholders aren't immediate. It often takes 2 to 5 years to see them. So we're trying to capture the impact of what a firm is doing today on these issues on its medium to long term shareholder value. And in order to do that, we need to understand how stakeholders are going to respond to the company's performance. What do I mean by response? The basic idea is that if a firm imposes harm on the communities outside the fence, or if it imposes harm on its workers, if it imposes harm on the environment, people might get upset. People might think that's not right, that's not fair, and they might demand that the government regulate, or they might demand that people boycott the product or service, or they might not want to work for the company. And so the costs that the firm imposes on its stakeholders today, over time, become business costs that show up on the profits and loss statement, that show up in shareholder value. And the ESG movement is really an effort to try to map this out. When, where, and how does it happen? As well as when, where, and how does it not happen? On the more positive side, maybe there's some firms that are creating huge positive benefits, and those can be captured by shareholders over time as well. So it's not just a question of risks, it's also a question of opportunities. What are some specific examples of the way stakeholders react? Well, if a firm is polluting too much, if a firm is harming its workforce, maybe there'll be regulations on the price of carbon, or regulations from on safety and health of its workforce. Maybe stakeholders will boycott that product or that service. Maybe they won't want to buy from that company, or there'll be a blockade in front of the fence of the factory so supplies can't get in and out. Or maybe there'll be competitors that enter into the space with a product or service that's less polluting, that's less damaging, or more beneficial, and people will switch. And so it won't be a boycott, it'll just be people shifting away from a polluting product or service or a company that's doing harm to one that's doing better. And so in each case, the government, consumers, workers, or competitors took an action because of your performance on an ESG issue. And in the end, that affects revenues, costs, and risks, and affects shareholder value. That's what we're trying to model and measure. So to start us off just with a little bit of a baseline, where are we in terms of your beliefs on the ESG? There's a quick first poll on, do you believe this argument? Do you believe that ESG factors are financially material, or is this just a fad? Is there maybe a few cases where this is true? Or should a firm's performance on climate, on social justice, other ESG factors be an integral part of valuation by investors and by corporates? So the poll is open, looking to see the results coming in. I'm getting the first trickle of polls coming in. Maybe give it a few more seconds to get people online and clicking through. So in terms of the responses we're seeing, we've got a converted group, it looks like, or a group of believers, in that the people who are attending this session are on the side of ESG being an integral part of valuation. So it's a good baseline, but hopefully you still want to know more and want to know how to do it then. And so let's start turning to that. First, for those who are already there, I think it's still worthwhile spending a few minutes on how we got here. How is it that ESG became such a central element in the discussion on shareholder value? If the audience is not unique, the use of this term ESG has really skyrocketed. It surpassed previous words like corporate social responsibility and sustainability. So we're seeing much more discussion of ESG in the press. And key stakeholder groups all believe the argument that you believe, that ESG factors are material. So CEOs, board members, investment managers, C-suite executives all believe that ESG factors are material, and their belief has increased dramatically over the past 3 to 5 years. So we've gone from having 10, 20, maybe 40% people agreeing with that to numbers of 50, 80, 90%, depending on the group we're talking to. So it's become a widespread belief that ESG factors are in fact material. Alex mentioned over $30 trillion of assets under management, according to the Global Sustainable Investment Alliance, claims they want to invest according to ESG factors, want to incorporate ESG factors within their investment thesis. And looking ahead, that number is only going to increase because millennials, who are going to form a larger and larger basis of assets under management, care about this more than the general population. And the trend in both the millennials and the general population is increasing over time. So we expect the 13% per annum growth to continue to increase. In August 2019, there was a notable shift in the opinion of the leading CEOs in the United States about what was the purpose of the organization. It went from being shareholder value alone, the precepts of Milton Friedman, where he talked about the purpose of the company is to maximize short-term shareholder value, to something closer to Wharton School, former Wharton School professor Ed Freeman, who wrote the stakeholder theory of strategic management when he was a professor here in the management department back in the late 70s and early 1980s, currently a professor at Darden. So we're shifting our perception of the purpose of the firm from just focusing on shareholders to shareholders being one of a set of stakeholders that CEOs have to attend to. A key driver of this is one man and one company. Larry Fink, CEO of BlackRock, the largest investor in most publicly traded companies in the world, has since 2015, in his letter to every company in which he invests, and the CEO of those companies in particular, called an increasing amount of attention to ESG factors. He's shaped the discourse around ESG for the last 7 years and would expect him to continue to do so in his 2023 letter. That's led more and more of the asset management community to pay attention to ESG factors and to start asking those calls that Larry Fink is calling on them to ask in the analysts' earnings calls. Many years ago, when we would talk about the materiality of ESG, executives and CFOs would retort, well, if it's really material, why aren't I hearing about it in my quarterly earnings calls? Now, 25, sometimes 30% of them are. So we're drastically increasing the percentage of calls which mention an ESG issue and on which companies have to respond. So I'm curious, you all said that you think ESG factors are material. Have you also experienced this kind of upward trend? So has there been a drastic increase in the importance of ESG for your company, your executives, your board? Has it just risen moderately, no change, or are there attenuating or diminished importance? So again, I'll let the poll results trickle in a little bit. For those who didn't see it, there's in the chat, you can get a direct link, or you can text the response to 22333, text Witold Henisz 106 to 22333 and start joining the poll. All right. Getting a few more responses in. There we go. Whoop, sorry. Open that up again. So we're seeing a dramatic increase or risen in importance for over 64% of the participants. So you're seeing that increased trend, now 67%, now around, yeah, still mid 60s. So you're feeling that trend as well. So there's an increased trend. You've heard so much good news. What are all the headlines about? That's where I want to shift the discussion next. What's behind the criticism of ESG, and how far do we have left to go for this movement to really be mainstream and really shaping corporate behavior? I think it's important to look at the responses to those same stakeholders in how well they perceive they can actually incorporate ESG factors into their valuation models and into their strategies. So over 80% of board members think ESG factors are material and that people should take them into account, but 64% of them don't think that their disclosure actually helps investors make informed decisions, and that number's falling. EY reports that the number of investment managers, over 80% of which think ESG is material, the number who report that they're satisfied with the data given to them by the boards and given to them by the executives has fallen from 22 to 12%. So we're seeing a surge in the belief of the importance, but a collapse in the belief that we have the data we need. PRI reports less than 10% of the investment managers believe companies are sufficiently explaining their strategy. McKinsey, who found that the majority of C-suite executives think ESG are among the most important strategic decisions, only 1 in 5 of them think they're very good at managing them. To highlight the data challenges, there's a recent study from the accounting literature where Peggy operates, reporting that of the material financial disclosures in companies' annual reports that deal with environmental issues, if you turn to the sustainability reports, where companies are supposed to be reporting how they're doing on ESG issues, 90% of the time, the financially material, environmental spill, contamination, negative event is left out of the sustainability reports. And this points to a huge problem. How can this be? How can companies not omit these huge financially material events from their sustainability reports? Because there are no standards for disclosure, because they're not audited, because they can put in them whatever they want to put in them. And what they put in them is good news. Wharton Professor Leo Pongelupe has recently shown that one of the things that's dramatically increasing in sustainability reports over time is not disclosure, it's the pixel green. He actually analyzed the sustainability reports from a large sample of companies and found that the percentage devoted to the color green is actually systematically increasing over time. A clear form of greenwashing, if you will, in that we're using more and more green trees, green backdrops, green colors, green fonts. Are we actually becoming more green? It's not clear. And the reason is because the companies can report whatever they want. And they report what makes them look good and what makes people feel good. And apparently that's the color green. Another more vivid way of showing this, if we assess the credit risk of companies, we turn to different rating providers. Let's go to Moody's, let's go to S&P, let's go to Fitch. They don't agree all the time, but they agree about 90% of the time in terms of is a company AAA, BBB, AA-. If you turn to the ESG ratings, the correlation between the ratings providers is between 0.05 and 0.6. So we have a massive data problem that every stakeholder points to. Investment managers in particular point to not only the data problem, but the lack of proof that using that data actually enhances financial performance. So while investment managers believe the logic that ESG is material, a consistent 55 to 60% say they have not yet actually incorporated ESG into their investment decisions. They believe they should, but they don't have the data to do it. The benefits of ESG incorporation are unproven, unclear. We won't consider factors that aren't purely financial. We don't believe and don't have proof yet that the ESG factors do affect financial performance. There isn't convincing research yet. We're unsure if this would actually be a breach of our fiduciary duty. These are the factors that are holding the investment community back. Again, a lot of this hinges on data. To give you one set of pictures that might highlight the data problem, here I'm looking at the correlation in a company year's ESG ratings from different data providers. Asset4, now owned by Refinitiv, Sustainalytics, RepRisk, True Value, who's now owned by FactSet, and then MSCI and the same providers along the bottom. And so in each cell, if you will, if you look at the top left, you see the correlation between Asset 4 and MSCI. Each dot is a company year. If Asset 4 and MSCI agreed who's good and who's bad, all those dots should line up on the 45-degree axis. Because if you were the best firm in Asset 4, you'd be the best firm in MSCI. You'd be at the top and the far right. And the worst firm would be at the bottom on Asset 4 and the lowest on the left on MSCI. But instead, you just see a blob. And that blob doesn't really look like anything like a 45-degree line. Now, there's a bit of an exception in Sustainalytics and MSCI, certainly not a 45-degree line, but at least an upward sloping blob. But most of the other correlations don't show any statistically significant correlation. And that's really problematic. The answer on who's a good ESG company depends on who you buy your data from. To go from the aggregate to the specific, let's look at Apple. Is Apple in the 10th percentile of environment, social, and governance, or is it in the 90th? Well, it depends if you buy your data from Robico or Sustainalytics or Thomson Reuters or MSCI. What about Amazon? Are they in the bottom or are they in the top? What about Facebook? Bottom 5, bottoms, are they in the 0th percentile or are they in the 90th? The answer depends on who you buy your data from. And this is really problematic if you're trying to make investment decisions. Again, the correlations across the top, 0.3 in environment, 0.2 in social, 0.16 in governance. Some companies are taking a different approach. Instead of just scoring how a company is doing, they're trying to measure the financial impact of its ESG performance. But what should they be measuring? How should they be assessing the social cost of carbon? How should they be assessing the economic consequences, the externalities imposed by taking water out of the ground? If you go to the science, we don't have agreement on what the social cost of carbon is. Should we account for it at $30 a ton or 150? Some people even say 250. Trump administration said 20. We don't know what the appropriate range is in the science, so how can a company account for it and have it be audited? It gets even worse if you go to sulfur dioxide or nitrous oxide. You see these huge variations, or PM10, heavy particulates. You see ranges between $1,000 per ton and $15,000 per ton. So even if we try to get beyond who's good and who's bad and what should we be counting and start dollarizing impacts, we see enormous heterogeneity in what is counted, how it should be counted, and what the social costs are. Then, not surprisingly, given all these data problems, if you go to the fund space and you look at the 428 funds that Morningstar identifies as having an ESG orientation, what's plotted here is their average returns relative to their benchmark. So how do they do relative to a non-ESG fund that invests in the same group of companies? That's the vertical axis. And on the horizontal axis, are they tilting away more to the right towards ESG or to the left, actually having below average ESG performance? What's really disturbing about this graph is, first of all, there's a bunch of firms that are to the left of zero on ESG, funds that are to the left of zero on ESG. That means there are a bunch of ESG funds out there that actually underperform on ESG. So really, buyer beware. The second thing that's disturbing is there's no evidence that tilting your portfolio towards ESG actually enhances your performance relative to benchmark. In fact, it reduces your performance. So you actually see significant reduction as you move to the right. You're reducing your financial performance relative to benchmark. If you drill further down and you look at the different approaches that fund managers are taking, there's some people who are really spending a lot of time engaging with firms, others who are really trying to do the financial calculations I was talking about. But then there's a bunch of funds that are basically just screening out some weak performers, knocking out the worst 5 firms, the worst 10 firms, but otherwise not doing much, just taking the subjective rankings and knocking out the bad firms. Then there's some thematic funds on the right who are more focused on a certain area like water or gender. And then some that are taking a very low cost way of knocking out poor performing firms. When we segment the fund industry into those six segments, we see that in only 3 of the segments does the ESG rating even matter for which funds get more capital. And the thing that consistently matters is how big the fund family is. If you're BlackRock, you can launch any fund you want and you'll get capital in it. If you're State Street, same if you're Vanguard, same if you're Fidelity. Now, if you're trying to draw money into an ESG fund and you're not one of the big fund managers, then the most important driver is not your ESG performance, it's the returns relative to benchmark. So even your ESG funds are chasing financial performance, not ESG performance. The best performing funds in terms of growth, who's winning the ESG fund competition, are the passive and transient screeners. They're the firms that are just knocking out poor performing companies. But the academic research suggests that's not going to give you financial performance, and it's not going to give you ESG performance or system level change on things like climate. So there's a real problem in that we're all excited about ESG, but the funds haven't figured out how to make money according to it. And the funds that are succeeding relative to their peers are just the big BlackRock funds, the big State Street funds that actually don't tilt very much towards ESG and don't drive financial performance and don't really drive performance on climate change. The funds that are doing the really hard work, the active ESG engagers and the ESG integrators, they're not seeing the same degree of fund inflows, especially in recent years, even though they're outperforming on financial and ESG targets. So we have a real greenwashing problem here. That's leading to some real criticisms of the ESG movement. Tarek Fancy, former head of sustainability at BlackRock, calls the ESG movement hypocritical. He says it's a dangerous distraction. He says we should give up and depend on government regulation. So does my peer, Andy King at Boston University in Bocconi, and Ken Pucker, who was formerly head of sustainability at Patagonia. They've criticized the movement, saying that no amount of heroic accounting could ever take seriously the impacts I'm describing between ESG and value, and it's hopeless to try. And so we should just regulate the price of carbon. We should just regulate the living wage. There is also criticism coming at the ESG movement from the right. Elon Musk saying it's a scam. DeSantis, Cruz, Pence, Pompeo, Peter Thiel, Michael Berry, all of these, Vivek Ramaswamy, all of these actors coming at the ESG movement saying it's woke capitalism, and it's attacking the ESG movement for imposing a set of values on Main Street investors. Who are you to say that climate risk should be factored in? Well, I think there is a logic that climate risk is investment risk. I think there's a strong logic there. And while we have some work to do, I don't understand their arguments. I don't understand why climate risk is an investment risk. Maybe I do, actually. Maybe their arguments aren't about logic or about the economics of climate change. Maybe they have something more to do with the political midterm elections in 2022 and the presidential elections in 2024. They think like critical race theory. They think like transgendered bathrooms, that this can be a wedge issue that divides America, divides rural from urban. People who are sympathetic to the idea of woke capitalism and people dictating to them how they make their investments might be sympathetic to an attack on the ESG movement. But really look at the two sides. One of them says climate risk is investment risk. We should factor it into our investment thesis. We don't have the data yet, but we're trying. The other says we can't do that. The other says we're not going to do business with anyone who does that, which means we're not going to do business with any of the most sophisticated financial institutions in the world that are trying to figure this out. We're only going to do business with small banks that adhere to us on an ideological basis. It's interesting that this is the new argument of the right. We're not going to listen to finance. We're not going to listen to economics. We're only going to listen to ideology. The anti-ESG movement belongs on the political pages, not on the business and finance pages. That's my take on it. I'm curious as to yours. What do you think about the anti-ESG movement? Do you think it's the beginning of the end of the fad of ESG? Do you think it's an alternative approach? Or do you agree with me that it's mostly political? Where do you come in on this debate? I agree, it's an important set of criticisms. So I definitely agree that we can't ignore it, that the data problems are real. And I also agree that it's mostly political. Looks like we've only got 2 responses in, but I'd say you're both right. Or maybe we're getting a few more in now. So I agree with both these points, that it's political, but the criticisms are valid and we need to do the hard work and we need to do the research. And I'm heartened that I'm not seeing too much at the top end of the scale, that you understand that this is more a political movement and it's not actually creating an alternative system. There is no alternative to try to figure climate risk out. Ignoring climate risk really isn't a movement. It's just bad investing.
Okay. Professor Henisz, we had a question that came in that maybe is somewhat related to the point of politicization of ESG. The question was relating to sort of the interaction or sort of the relationship with DEI movements and DEI initiatives. Do you have a view on it? Are the two separate? Are they somewhat overlapping? Are they on parallel tracks? Would like to hear your thoughts there.
Yeah, it's a great question, Alex. So I think they certainly are on parallel tracks, and I think they would benefit from a little bit more coordination. There's been a longstanding movement to address diversity, equity, and inclusion in the workforce, and to address issues of systematic discrimination. And that can harness the creativity and the perspective of companies to see things, to sort of improve their peripheral vision, improve their creativity, improve their performance, and to make people feel valued and more valued in the workplace. The ESG movement has started from a different space, often of thinking of non-traditional risks, including things like racial equity in the workplace. It doesn't have the depth of experience and understanding of all the ways to measure that, to turn that into practice, but could benefit from learning from the DEI movement. I think similarly, the DEI movement could benefit from some of the efforts in ESG to look across a broad set of firms and really try to prove the business case of DEI. And so I really hope that they don't view each other as rivals or substitutes, but really complements going forward. And we're certainly trying to do that at Wharton, where we've launched a DEI major and an ESG major. The top two priorities at the Wharton School of Dean James are issues around the Coalition for Equity and Opportunity, which addresses DEI, and the ESG movement. And we're working very much hand in hand and in cooperation, but also recognizing that each one has some distinct perspectives and backgrounds, so they can learn from each other. They're not exactly the same thing. So it's a great question. I'm going to transition, if I could, into thinking about how we get out of this problem. We have soaring interest, but we have a lot of problems. What's the way forward? I think the way forward is to come back to where I said ESG starts. It starts with saying that ESG is about value. Now, when we teach value in our classrooms at Wharton, we come to a very simple framework called the value stick, that your job as a manager is to either make customers happier or get suppliers to give you stuff more cheaply, so you can attract more value and a higher margin for your firm. But that's ignoring everything we've been talking about in terms of ESG. It's ignoring how the way you treat your suppliers, the way you treat your customers, the way you treat the natural environment might have impacts on your revenues, your costs, and your efficiency going forward because of a host of hidden factors that we're not sufficiently modeling. And so the ESG movement is really just about good economics, good business, good valuation. But let's not just look at what's above the iceberg or above the water level. Let's look below as well. Let's factor all those things into our valuation calculations. Let's start modeling the risk that the government imposes new regulations, that workers or communities protest, or customers boycott, or that competitors come in with new products. Let's make that part of our valuation of a company. Let's not treat that as something that's outside the scope or beyond our ability to model. We model a lot of things that are really hard with a lot of uncertainty. We should be modeling these ESG factors and how they impact the P&L. So we need an expanded value stick that encompasses not just customers and suppliers, but also takes into account government and employees, capital providers, and the way they view ESG risks and opportunities. To give you an example of what that means, climate risk, what does that really mean? Well, there are two main ways which could affect your business. There's the physical risk. Your plants, your equipment could be underwater, or your workers could be exposed to extreme heat. Those are two types of physical risks of climate. There's also the transition risk. We might have different prices of fuel in the future because we're moving towards a clean energy solution, towards climate transition. We might have taxes on carbon. We might have taxes on coal. So there could be transition risks as the government responds to the climate transition and climate risk. Those are going to have micro and macroeconomic impacts on individual firms and on whole sectors and on whole economies that translate into credit risk, market risk, operational risk, and liquidity risk. How good is your ERM system at modeling those risks? And what's not here is the opportunities. What about all the new supply chains? What about all the new products, all the new services? What about coming up with green cement, green steel, green energy? Those are huge growth opportunities. So I'm just focusing on risks on this side, the costs, but they're also the opportunities of the climate transition. We do something similar on labor practices. We could start saying, how do DEI practices, how does the ability to address extreme heat events, how does that translate into injury, well-being, illness, turnover, healthcare costs, productivity, and quality? ESG is just about good accounting, good finance, good business, but modeling things that we typically have ignored or not focused on the long-term impacts of. In work with McKinsey, we work through 5 common pathways by which ESG hits the profits and loss statement. And I'll go through these quickly so we have more time for questions at the end. The first is top-line growth. The most rapidly growing segments in customer products are areas that focus on sustainable products that address ESG issues, that are less impactful on the environment, less negative to the supplies of fish, less negative to the workforce. That's where all the growth is coming in consumer packaged goods. We can also address costs by addressing ESG. When Walmart puts solar panels on its roofs and forces its suppliers to reduce packaging waste, Walmart saves money on energy, and Walmart saves money on its trash disposal costs. It also saves money on logistics, transportation, and distribution costs. So there may be real cost savings if we start thinking about ESG factors. We may also avoid a number of costs. If our stakeholders aren't upset, extreme, we don't have to hire as many bodyguards when we walk around a country. We don't have to redesign as many projects. We don't have to spend as much on risk management and insurance. We don't have to replace as much equipment that's been damaged because workers or protesters have attacked it. We're not losing as many days to shutdowns. We're more able to expand our facilities. I won't keep going down the list, but you see, if you look at your P&L statement and you look at the variances between what was expected and what was realized, and you ask, why did that happen? Why weren't we on target for our cost estimates, for our revenue estimates? Did it have something to do with our performance on ESG factors? You'll start seeing all the avoidable costs that if you invest in ESG, you might be able to partially mitigate. Over 30% of corporate profits are at stake from regulatory interventions across a wide array of industries. That could be pricing regulation, environmental regulation, labor regulation, but government introduction of new regulations can put profits at stake, and firms have an interest in engaging in those discussions proactively. I can give you some high-profile examples of companies that experience legal liability because of failures on ESG. The Volkswagen emissions scandal, over $15 billion in legal judgments. Was it foreseeable if you were an investor? Was it something Volkswagen maybe could have foreseen? Well, according to standard ESG rankings, they were in the 27th percentile of the automobile companies in air quality. What about Vale's iron ore tailings dam failure, which killed 222 people and threatens bankruptcy for the company if $55 billion in legal damages are awarded? 5th percentile in human rights and community relations. The data is not perfect, but for some of these extreme events, there were warning signs. ESG strategy can also increase productivity. Our own Adam Grant has shown how much harder workers will work if they believe in the purpose of the organization. Claudine Gartenberg also has undertaken that research, and the topic of a recent book called Purpose and Profit by George Serafim, which is largely based on joint work with Claudine Gartenberg. We see workers working harder, more hours for less pay even, if they believe in the purpose of the organization. We also see better allocation of CapEx. So these items on the P&L are part of our evaluation exercises. We're just not thinking enough about how ESG factors influence them. When we take all these factors into account, when we measure the total externalities of the S&P 500, as we did in the total value framework in engine number 1, we see a correlation with shareholder performance. We see especially the bottom performing quintile on externalities drastically underperforming the S&P 500 as a whole, and even the bottom 2 or 3 quintiles underperforming the top 2. So measurement is hard. We can't capture every externality. We still struggle with things like human rights, living wage, and really dollarizing that. But when we take this approach of saying, what is the social cost of carbon? What are the costs of the use of water? What are the benefits and costs that accrue to workers? And scoring companies according to that, and then assessing over what time frame will shareholders likely be impacted, we can come up with predictive signal that affects long-term stock price performance. So I went through 5 pathways very quickly: revenues, costs, regulatory and legal issues, productivity uplift, and investment opportunities. Curious about what you think for your firm the most important pathways by which ESG factors hit the P&L are, and among these 5. So regulatory and legal is coming in as a big one. So, this calls for more attention to government affairs and government affairs spend, and not thinking about government affairs as a firefighting, but something that you should be strategically looking at in terms of allocating resources to reduce regulatory legal inquiries. Investing more in our workforce because of the productivity uplift, looking for cost reductions. So a pretty wide distribution across these. So one of the things that's interesting is to think about how these pathways differ across different industries and different firms. There isn't one answer in terms of which pathway is most important. For the energy industry and other heavily regulated industries, it's probably regulatory and legal. For consumer packaged goods, it's probably top line growth. So there are going to be enormous variance across industries and even within them. And that's a topic we're exploring in an industry research partnership with the TIA Institute in Nuveen. So final few slides to try to pull all this together. Where are we headed? When I'm an optimist, I look at the data like this. Over the past 5 years, we've become much more sophisticated in the way we allocate ESG assets under management. We're giving up on the simple screening that academic research suggests doesn't work, and we're doing more and more what's called ESG integration. That's the effort to build the valuation case for how ESG affects the P&L, the new way of seeing value. That's the largest segment of ESG investing. And if you look at the bottom panel, it's the segment that's growing the fastest. And we're moving away from some of the strategies that we know don't work, like norms-based screening and positive or best-in-class screening. That's encouraging. We're also spending more and more money on ESG data. We're now spending $1 billion on ESG data, and the forecast is that'll grow to $5 billion by 2025. That compares to $12 billion currently, and as much as $20 billion on total financial data by 2025. If ESG really matters, we need to invest in the data to interrogate how, where, when, and why. And the fact that we're spending more is encouraging. Where I'm discouraged is the anti-ESG movement. 27 states have introduced regulation or legislation to ban the ability of financial institutions that think ESG risks are material from doing business with the state. The state of Texas has actually gone the furthest in doing this, but other states have joined: Florida, Louisiana, West Virginia. 19 state attorney generals have filed letters complaining to BlackRock that they're introducing political factors into their investment thesis. I don't understand the argument there. Again, to me, climate risk is investment risk. It's not a political factor. I thought we'd gotten past the point of whether climate risk was real or not. We've gotten past climate denial, but we haven't. In fact, it's exactly the same people that funded climate denial that are behind this. Look whose map this is. This is the Heartland Institute, one of the think tanks that's most central in the in the climate denial space, and that's been funding the fossil fuel industry. So we do have a threat here. ESG is very much in the crosshairs. I'm encouraged that 8 Republican attorney generals didn't sign this letter criticizing BlackRock. I also hope more people would pay attention to the fact that when the state of Texas politicians imposed this restriction on their ability to do business with banks and financial institutions that think climate risk is real, our own Dan Garrett at the Wharton School's research showed that imposed a cost on state of Texas taxpayers of between $340 and $540 million. I don't think it's in the fiduciary or political duty of the comptroller of the state of Texas to impose a cost of $500 million to try to win political capital coming into the midterm elections, but let the state of Texas taxpayers decide that. When I look at the anti-ESG movement, and especially when I hear people claiming, oh, this is a real alternative, this is a battle. I don't know, the way I keep score, there's no battle. As a Yankee fan, this is more like the way the Houston Astros played the Yankees this year. It was a mismatch. On one side, we have assets under management of $35 trillion saying they want ESG investing and $4 trillion actually doing it. On the other side, we have $400 million, and most of that is Peter Thiel's money. There's very little small investor money going into the ESG movement. When ESG shareholders file shareholder resolutions, they get 30 to 40% support. When the anti-ESG movement files their shareholder resolutions, Stephen Malloy, Leonard Leo, they get 7% support. And some of the 7% is asking companies like Disney or Apple to disclose human rights issues in their supply chain. We're calling that an anti-ESG movement because it's funded by Malloy or Leonard Leo, but we're asking Disney to divulge human rights issues in their supply chain. That's actually an ESG shareholder proposal, even though it's counted on the other side because of who's funding it. 27 states are considering banning these financial institutions from doing business at a cost to Main Street investors and Main Street taxpayers. I think it's unfortunate. I think it's costing BlackRock business, but they're not going to give up on ESG because there's trillions of dollars in business at stake from modeling climate change correctly. So I'm optimistic, but I'm a little nervous about the anti-ESG movement. I guess this is the final poll question I'll ask you. One argument out there is that ESG is a dangerous distraction, that we've come to the end of the ESG movement. Another is that it's time to roll up our sleeves and make progress on ESG integration, that we've exposed the criticisms, but that means there's work to do, not that we should abandon this movement. Curious where, after this presentation, you come out between those two debates, or sorry, between those two sides, or if you find a third one. So far, we've got a 100% response on the one that I'd agree with, which is it's time to roll up our sleeves. Give it one more second to see if there's any heterogeneity. It looks like unanimous support. Well, I have to say I agree with you. Let me, in the last minute or two before we open it to questions, just highlight how much we're doing here at the Wharton School and its ESG initiative to do exactly that. The mission of the ESG initiative is to expand the boundaries of business research and education to encompass ESG factors in order to harness the power of business to solve the social problems incident to our civilization. That was the call of Joseph Wharton when he founded this school in the 1880s. What are we doing? We're doing the research, and I mentioned a lot of it today, Leo Pongilupe, Dan Garrett, my own work. That feeds into our education. Education in the classroom, new ESG major, 30 new electives in the ESG space, ESG treks, such as the one that Peggy mentioned that I went on with the WEMBA students to London, co-curricular experiences where our students can do ESG consulting projects and other ESG experiential activities outside of the classroom. And then we engage with outsiders by sharing our research in events like this, by working with industry research partners, by the partners who take on our students. We're engaged in dozens of research projects that I don't have time to describe, dozens of new curricular, co-curricular experiences, competitions. 4 new executive education programs are going to be launched next year. And we're partnering with the best and brightest in industry who are trying to make progress and rolling up their sleeves on doing ESG integration. These are our partners who are propelling our research forward, who are working with our students, and who are trying to do the hard work to figure out where, when, and how ESG factors are material, should be affecting valuation, should be affecting strategy. I hope in some capacity you'll join us, whether as students in the WEMBA classroom or encouraging your employers to contact us and look for ways to partner together on this exciting research agenda. It was great to have this opportunity to speak with you today, and I'm going to drop out of the screen share and take any questions that have come in over the time from Alex.
Thank you, Professor Henisz. I think you've certainly laid out a really compelling case for the rapidly evolving landscape of ESG. I myself found it to be quite a bit of a surprise that there is an anti-ESG, movement, if you will, of sorts around the world, if you will. There were a number of questions that sort of came up, some a little bit more granular, others a little bit more sort of at the strategic level. One question that came up, which I also had in my mind, was there was such a wide variance of scoring and rating ESG impact and the integration within organizations of ESG sort of, standards, if you will. Do you believe there should be a unified standard for the definition and the metrics for ESG?
It's a great question, Alex. And a lot of people say, well, if the data is this bad, it's hopeless, and this is part of the, it's a distraction we should give up. Like we've been trying this for a while and people don't agree. Well, I mean, let me give you the academic answer first and then maybe the simpler answer. So the academic answer is, look, this is a problem where we don't have a good measure and we know how to deal with that in academics and in data science. It's called a measurement error problem, and there are techniques to address that. So just because we have measurement error doesn't mean we can't make progress. But let me give you a more substantive and punchier answer. The critics are saying you can't tell us which company is good and which company is bad on ESG, and so it's hopeless. Tell me the list of which company is going to financially outperform, forget ESG, just financially outperform all of its competitors over the next 10 years. Which company's stock price is going to go up the most over the next 10 years? Who's got that data? Because if they've got that data and it works, like I'd like to buy it, I'd like to see it. the point is here, it's an unfair standard. We can't figure out financial performance in a certain predictive way, and yet we're asking a new, rapidly growing, uncertain scientific field to meet a standard that we can't meet in our regular financial reporting. That's unfair. The goal for ESG reporting should be to get as good as regular financial reporting, which means, yeah, there'll be less variance, there'll be a higher legal and regulatory floor, but there's still gonna be a lot of disagreement. Buy and sell recommendations don't line up. We don't know which stock is going to outperform over the next 10 years, much less the next 10 days, but we try to figure it out. And there are lots of people competing with different answers that some people find convincing. We're in the early stages of that journey in ESG.
With it being in early stages, having the opportunity to see different measurements, I imagine, will help reveal what could inevitably be a standardized method for evaluation, I would imagine.
I don't think we'll get to I think the way to think about it is the regulatory floor will come up. So there'll be some things that are standardized. Say the way you report, the SEC is talking about us, that we're gonna have scope 3 emissions on carbon. So your carbon emissions, both in your factory, from your energy, and in your supply chain for large companies will have to be disclosed. That's gonna be standardized. I mean, assuming the SEC regulation goes through, and it is being standardized in the European Union. So even if we choose not to do it in the US, firms will have to do it in Europe. But that's only one question. There's dozens of additional ESG questions. What about water? What about PM10? What about sulfur dioxide? What about recycling? What about biodiversity? Over time, we'll get higher and higher regulatory standards, but they'll always be, in the same way there is with financial reporting and accounting, there's always be, well, what about this? What about that? Couldn't we do this? So the floor will come up, but the money will be made and the impact will be made above ground, above the floor, between the floor and So the goal is not here an agreed common set of global standards, because we don't have that in financial reporting. The bar keeps getting raised. What we want to get to in ESG is less variance, a floor, but still a lot of ferment and a lot of activity. We won't get to the point where that goes away, because it doesn't go away in financial reporting.
Interesting. That's a helpful view, Professor Henisz. Another set of questions that I think I as an organization leader ask myself is, I have a fundamental appreciation for what ESG represents for a number of reasons. I'm a millennial myself, and as more millennials take on leadership roles within organizations, whether it be CXO level or something of another sort, if you will, what should we look for in our talent that we source for, hire for, so that there is that fundamental appreciation for ESG? And I would sort of argue that if our organization is equipped with individuals that have not just exceptional performance, but exceptional appreciation for what ESG represents, that it could lead to an intrinsic motivation that you described. So any thoughts around that? What would be those core competencies that you imagine those that organizations would be looking to hire for to align with ESG?
I like the question. I think I usually hear it the other way. What should employees be looking for? Because millennials are demanding this. So, I do think, let me just tackle that more common question first and then come to yours, the more interesting one. I think, millennials should be asking their companies, like, where are you on the climate transition? How sophisticated are your ESG practices? Are you really looking at these risks and opportunities? How do what are you doing to make your workers feel more whole, more safe, more rewarded in the workplace, to be able to bring their whole identity? Tell me about what you're doing there. So I think employees should ask of their employers. Now, what should employers look for in their employees? Well, I think one thing is to maybe that they've been educated in a school that thinks ESG is central and that has a major and has 30 elective courses in ESG. So I think there'll be some differentiation among schools and how sophisticated the training is. I think for their existing workforce, maybe being retrained in ESG and having that be done by the best faculty, not just, I think one of the things we're doing at Wharton is really our research faculty. It's our tenured and tenure track faculty. We're not bringing in just practitioners to do this. Practitioners have a role in the educational system, but we need cutting edge research. And so we want that being done. So I think you want to look at the school and how central the ESG discourse and also DEI, as was brought up earlier, how central those are in the training of managers, and whether the students have had exposure to some of these issues, and then understanding, their willingness to be part of that struggle of rolling up the sleeves. That how comfortable, like this is an area of managing uncertainty, of unknown unknowns, and so I think like any of those processes, you need a more interdisciplinary, a more an ability to deal with abstraction, to deal with uncertainty, to not just be looking for rote memorization skills, but critical thinking skills, because we don't have all the answers yet, and we're not going to anytime soon. So I think there's a simple cut, which is just how much training have they had, but then there's the type of thinking you need, and I think it's much more critical thinking, discerning reasoning, and probably data science skills and data imputation skills, because there's going to be a mess in the data for years to come. So we're going to need some of those quantitative analytic skills, not just the way you think, but the tools you have to interrogate the data.
There is so much ambiguity that it requires someone to be able to ask really good questions, and then to sort of take data and information and then process it and then make informed decisions. And that oftentimes is what we typically look for in our talent for the purposes of maximizing an organization's bottom line. But again, reframing this discussion to sort of have it be more incorporating of ESG, I think makes a lot of sense, as you've mentioned. Another question that sort of came up was around, does ESG at all, and if it does, how so, change M&A activity, whether it be during due diligence or at other stages of the process? Any thoughts regarding that?
Yeah, so my former doctoral student, Kate Ojimkowska, and two colleagues here at Wharton, Zeke Hernandez and Emily Feldman, have actually done research on that very question. And in their early work, they show in the same way that you might acquire or not acquire a company because it has good patents, or its patents align with yours, or it has a brand that aligns with yours, or it has management skills that align with yours or don't align with yours. You have to think about the ESG performance of the company and whether it aligns with yours. Where there's conflict in that, that can undermine the success of an M&A. Where there's alignment, where it sort of broadens your portfolio of, well, we've got the capacity to deal with water, but not so much air, or we're good with this set of stakeholders, but not that set of stakeholders. There can be complementarity or conflict in the ESG scope of activities of an acquisition partner. It's a lot harder, a company that's been at the forefront of maybe thinking about ways of getting higher margin customers willing to pay more. That might be one strategy. Let's go for the niche customers, but someone else has been really focused on cost reduction. That might be a benefit to bring those two together, or it might create conflict, but you need to think through the overlap, the symmetry, the complementarity between what risks and opportunities you're exposed to and how you adapt to them as part of an M&A due diligence, in the same way, and an integration process, in the same way that you think about organizational culture, that you think about product lines, that you think about patents. It should be part of that mix, and that's exactly what Kate, Zeke, and Emily show in their research.
Yeah, very interesting. That's helpful. Thank you for pointing out those references, Professor Henisz. We may have time for maybe one more question, and so maybe this is a good one to sort of have us sort of do our own due diligence and research, if you will. Any countries that are leading the way, in your opinion, on ESG, whether it be from government support or just from sort of more grassroots?
Well, I would say, the European Union has certainly been ahead of the US in terms of regulating on these issues and having a stronger background in thinking, I would say the Dutch in particular, thinking about the values overlap. APG, the Dutch pension fund, is really one of the leaders. I would say the US, as it's been shifting into a value proposition, the US has really leapt ahead, and engine number one, a number of the investment banks in the US, Calvert, Parnassus, there's been a real surge of sophistication in the US. And so I think there's a lot of dynamism here and a lot of excitement. I'd certainly say those are the two most advanced markets, and others should be following, and there's a lot of opportunities, because if you think about where is deforestation happening, where is living wage an even bigger issue than it is in the US, it's in a lot of frontier markets. Where are human rights a bigger issue? So I think there's enormous opportunity in emerging markets and frontier markets, but we have the data problems are even worse. So if you can figure out a way to address those, the opportunity in other markets is very large. I would say the US and the EU are ahead.
Great, and I think sort of the final thought of opportunity. I think there's a lot of opportunity ahead of us as we sort of look at the space, and just to sort of wrap it on that note, I do want to thank you, Professor Henisz, for taking the time to be with us today. We had quite a number of questions that came in. We weren't able to get to all of them, so I do apologize for that. But for those that attended, we do appreciate your time and really appreciate the discussion. It's very clear to me again that, from listening to your insights, Professor Henisz, that it's a rapidly evolving landscape. There's a lot to learn. There's a lot to discover across different sectors, whether it be financial services or those that are more in entrepreneurial organizations. So your perspective is certainly very well received. And I speak on behalf of the entire audience as well as Ivy Exec to say how appreciative we are of having this be part of our webinar series with the Wharton School this year. So thank you all for attending. Please be on the lookout for an email from us in the coming days. And we look forward to having you join us for our next session coming up in the weeks ahead. Thanks so much, everyone.
Cheers.
Cheers.